What is a bank? A commercial bank is basically a financial middleman. It connects savers with borrowers to buy homes, cars, or start businesses. When you put money in a checking or savings account, you're making a deposit. For the bank, your deposit is a liability, which means the bank owes you that money. When the bank gives someone a loan, that loan is an asset for the bank because the borrower owes the bank money. The principal is the amount borrowed, and interest is the extra fee for borrowing. Banks usually pay savers a small interest rate on deposits and charge borrowers a higher interest rate on loans. That difference, which is called the net interest margin, is one big way banks make money. Fractional reserve banking. Banks don't keep every dollar in a vault. They keep a safety cushion and lend out the rest to people and businesses. Think of it like a money echo. You deposit $1,000. The bank keeps $100 as a safety cushion and lends $900. That $900 gets spent and ends up deposited in another bank. Now, the bank keeps $90 and lends $810. Then $810 gets spent and redeposited, keep $81, lend $7 to $9, and so on. So the same original $1,000 keeps getting reused across the system, creating many deposits and loans. That chain reaction is what we call the money multiplier. It can boost spending and growth. More loans can mean more homes built, more businesses opened, more jobs. But if lending gets too wild, it can overheat the economy. More borrowing can push prices up and inflate bubbles. So banks are like the volume knob. They decide how fast that money echo grows by deciding who gets loans and on what terms. Now the twist, in textbooks, the multiplier is tied to a required reserve ratio like keep 10%. But in today's US, the Fed's reserve requirement has been 0% since March 26, 2020, so the multiplier isn't a fixed number anymore. It depends on how much liquidity banks choose to keep as a safety buffer and how willing they are to lend. Which raises the next question. Who influences banks' mood? Tight or loose? That's where the federal comes in. So who is this mysterious federal everyone talks about? In the US, that usually means the Federal Reserve or the Fed, America's central bank. It's called federal because it was created by Congress to serve the whole country. And it's not just one building. It's a system, a board of governors in Washington, D.C., plus 12 regional Federal Reserve banks across the US. Now, the Fed is not your everyday bank. You can't open a checking account there. So what does it do? Job number 1, the thermostat. Roughly every 6 to 8 weeks, the Fed holds an FOMC meeting. At the end, they announce one thing everyone cares about. Are rates going up, going down, or staying put? That decision can raise or lower your borrowing costs, mortgages, car loans, and credit cards. And it's not just you, companies are addicted to this rate dial too. Job number 2, the firefighter. In a panic, it can act as a lender of last resort so the system doesn't melt down. Job number 3, the referee. It helps supervise and regulate banks to keep the system safe and stable. So, in short, the Fed is like the strict but protective mom of the banking system, making sure the game keeps going and the money keeps flowing. But you might still ask, okay, what if my bank itself fails? That's where the FDIC comes in. Think of it like the seatbelt for your bank deposits. FDIC stands for the Federal Deposit Insurance Corporation. It's a U.S. government agency that insures bank deposits at FDIC-insured banks, typically up to $250,000 per depositor, per bank, per ownership category. If an insured bank fails, the FDIC steps in so you can still get access to your insured money. Good money habit, keep your emergency fund in a liquid, FDIC-insured deposit account and double-check your bank using the FDIC's Bank Find tool. So next, borrowing. How does it work? Borrowing can be smart if you control the risk. Here's how to borrow safely. Rule number 1, read the price tag APR. APR annual percentage rate is the all-in yearly price tag. It includes interest and most fees. If APR is high, that's a warning light. Rule number 2, don't borrow once with high APR. High APR debt for short-lived stuff is bad debt. If you're swiping a high-interest credit card for something you want but don't truly need, that's toxic debt. Rule number 3, always know your budget and your cash flow. If you can't pay it off, don't borrow. Quick recap. Banks match savers and borrowers. The Fed steers interest rates and keeps the banking system stable. FDIC protects deposits up to $250,000. APR tells you the real cost of borrowing. Watch out for sneaky fees and never use high APR debt for unnecessary ones.